Median value of savings and checking balances are more than 40% higher than 2019 for all income levels. As you look across the business, consumers, companies, just how resilient is this economy still?
Well, Liz and the team do a great job of putting this out, and we purposely created the Institute so we could get this data out. And it's not a reflection of what's coming tomorrow. It's more a reflection on what you see in the past. But it's very granular, 60+ million customers, 37 million checking account holders, and they have been remarkably resilient. And so the idea, if we were sitting here last year, this time we'd be talking about our team was predicting a recession somewhere early this year. It didn't. Then they took that off the table as we moved through the year, and now they're predicting 2% plus growth for this quarter. So you've gone from negative to slightly positive 2%. That is returning to the mean. It's not outsized growth. It's actually slowing down. So people can't forget we're going from a 4 to 5% growth rate to 2.5% growth rate is slowing down, and the restriction on economy accomplishing its purpose. Meanwhile, the consumer is very resilient, and that's providing an anchor to windward that the Fed has latitude that a lot of places don't have, that they can hold the restrictive and let the economy really catch up. But they have to be mindful of the change. At some point, that consumer will slow down, and they have slowed down their spending. And so last year it had been 10% growth. This year, in the fall, 5%. Now it's down to 3 to 4%. And they've got to be careful they don't overshoot. So this is the tension we're in right now, which is this resilient economy, and actually, as you said, Lisa, actually trying to bring inflation down. Since the financial crisis to now, most central banks are trying to get inflation up. And so it's a completely different execution, and that's what we got to get right.
You're dominant in small business lending. Yeah. I'm just wondering just how much confidence there is out there still in corporate America at the lower level, in the small companies across this country.
If you say by virtue of their activity, it's strong. But on the other hand, line usage, and Wendy will be on here later, she'll talk about that. Line usage has come down a bit, which means that the cost of borrowing went up, and so therefore I'm a little more careful. And so hiring's a little more careful. Equipment purchase, a little more careful. And so, well, they're fine making money, and the profits are strong, and the team will talk about profits driving this market, and the EPS estimates for public companies. Even mid-sized companies are participating in that. The American economy is the dominant economy in the world right now in terms of activity and interest and investment, and lots of good trends for it. But on the other hand, why aren't they using their line so much? It's a little more costly, therefore you're a little more careful. And that's the tension we're going through. Everybody's trying to really figure out how this economy will perform. And 4 months ago, people were worried about a recession. 6 months ago, worried about a recession. Now they're not. But now the question is, do they really want to invest heavily in it? And that's where you're seeing a little bit of tension here. So everything's fine, solid, resilient, all the words you wanted to, but it has to sort of work the next twist in the economy to get back to normal.
It's funny, I hear some of the people who work for you, and they sound incredibly bullish. Nothing's wrong, whatever. Is it your job to basically look around corners and see what potentially could be the problem, but otherwise things are screaming, and it suggests that even 4.5% 10-year rates would be just fine for the lending and the activity that you're seeing?
Well, I think we're also adjusting as a company and as an industry and as a society to a simple thing that from 2007 or 8 till 17, you had no interest rate. Then you had interest rate for about 24 to 36 months. Then they were dropping rates in 2019. Then the COVID comes and they drop. So we've never really had a normal interest rate environment. What would have typically been a 3% front end rate, 4 to 4.5% back end rate, a normal sloping curve, real interest rate. It hasn't occurred for anybody under 40. They literally weren't working back then. So, and that sounds curmudgeonly, but the reality is that's true. So everybody's adjusting this. So these high rates at 4.5% in the 10-year are not high rates in the grand scheme of things. They're high rates in the last 15 years. So we got to adjust to that, and that'll take time to work through the systems and models and thought process. Our team is the best team in the world in research, and you're going to hear from a lot of them today, and your viewers will benefit. On the other hand, as you look at it more broadly, my job and the team's job at the top of the house is to make sure we're balanced for all outcomes, and that's why we're always worried about what happens tomorrow, and we plan for it.
The balance in outcomes is leading to some really frustrated and bored traders, and we talk about that with a lot of people who basically say there's not a lot to do because you can't really get an edge. Are you seeing that in trading activity? Are you seeing that in trading revenues as people basically have no incentive other than just to hold NVIDIA, hold on to, some of the credit that keeps on rallying and just, make bank?
Well, our team has just come off of last year a record amount of revenues in the quarters, a record and growing quarter over quarter, and we think they're going to fare well this quarter. We told the market that a few weeks ago. And so Jimmy DeMar and the team that's out here, the research team under Candace and the investment banking team under Matthew, are driving the business and actually gaining share. And so while pools are down, investment banking, we've gained some share there. While pools are stable, flattish, we're actually up, and that's different in this business. And they do it with the right risk. They made money, I think, every trading day last year, nearly every trading day for the last 5 years. And so they do it the right way. Is that boring or not? You have to ask them. It's just fine with us because at the end of the day, that recurring capability, that ability to keep delivering for clients and doing what they need to do and make money at it and deliver for the shareholders and get a return on capital is what Jim and the team have done a great job.
You alluded to it. Have you maintained that momentum from that record fourth quarter?
Yeah, we think we're this quarter start off well. The team's doing a good job, and when you get to be bigger and bigger, it's hard to keep that growth going. They keep doing it.
Can we talk about the M&A slump as well? Are we working our way out of that? We wake up every single morning, we've got a new big blockbuster deal, and then we have a conversation about whether they can actually close it or not because of antitrust concerns down in Washington, D.C. Do you find us exiting that slump this year? Is that what you're looking for?
I think until there's a clarity on policy, that question is going to come up every time a deal is announced. So the companies are actively engaged in a dialogue, trying to figure out the strategic moves, and then the question is, can they get the deals through? And that happens in all industries. We need to get this resolved. We need to get to a more rational, predictive outcome to have people willing to take the risk of putting their company at risk for a sell side, and that's really what it comes down to. The buyers put themselves somewhat at risk. The sellers really put themselves at risk because a company, hanging in abeyance for a longer period of time is a tough place to be. Having been there before in my life and having caused people to be there a lot in my life, it's a tough place. And so how to run the company, what you can do. So I think we need to get a faster turnaround. The idea is these transactions don't change this month or a year from now. They're the same transaction. People need to get after them, look at them, decide what they're going to do, and give clarity so that the market takes place. The good news is, investment banking revenues have stabilized and moved back up, and that's good. But the M&A piece is still the piece that could come on and push through.
Do you find that some clients are reluctant to make deals based on what you just
100%.
said? Even though they make business sense, they just don't even want to entertain the conversation?
Because the risk-reward balance is so tough. Not everybody has the staying power to fight through, lawsuits and time and effort and things like that. And so it really requires if you said you needed 10 points of strategic import out of 10 to do it 10 possible points, you might need 7 before. Now you need all 10 because you really have to say this is worth hanging on to and fighting through. That's a different environment. Now, against that, you are seeing deals announced, and that's because they make strategic, compelling sense for that buyer, seller, et cetera. But it's just been slowing things down, and I think as there gets a rationality here and around the world, because remember, none of these deals are simple anymore. For any company, they have operations in Europe where there's same sets of approvals or different sets of approvals and operations in other environments. But at the end of the day, consolidation comes because of strategic import, and I think you have to let capitalism run.
So let's just talk about some of the policy shifts, which is nice, gentle allusion to the election later on. Potentially they could offer some more certainty. What kind of M&A boom could you see after that certainty has been established?
We'll see. I mean, I think, elections are elections. This company, the oldest part, has been around since 1784. And, there's been a lot of elections since that time frame. And, we have to adjust. I think you guys asked me in Davos, do you have a drawer for one outcome, a drawer for... The answer is no. We just run the company and drive it. So, I think certainty around the election process here and around the world will add to, okay, we know what we're dealing with and go on. And so that'll create some energy. But I think we have to be careful to say one thing leans one way, one thing leans like, because frankly, the politicians have to get this right for the good of their own state economy, country economies and stuff, and I think they're all struggling with it.
So we talk to a lot of strategists, political policy strategists, and they all say no one can really quite believe that it's Trump versus Biden again, and so they're trying to figure out who it's really going to be. Is it going to be you?
Me what?
Running for office. I mean, this is sort of what people are talking about. They're talking about Jimmy and I. I mean, this is sort of something that comes up in your discussions.
I've got a great job here.
I had a feeling you wouldn't put your hand up to be Treasury Secretary in front of the team this morning.
I know, right? You want to make sure
I've got a great job. At the end of the day, our job, my colleagues that are in the leadership across all industries, is to help any administration be successful, and that's what we try to do here and around the world. And and those are tough jobs, and but I don't think I'm running for office, so I think I've got a great job here, and I've got to continue to do it and try to help this team and everybody be better than we could be tomorrow than we are today.
There's been some fires to put out over the last 12 months in the industry. It's been a year since SVB failed. NYCB has been a new issue. Seems like last year was a rate shock, and this year just big worries about maybe a credit shock. Have you noticed any deposit flight coming towards you from regional banks in any way, shape or form similar to what we saw 12 months ago?
There hasn't been the kind of change there was last year because, you know, there are unique business models. That's what's not involved. A little bit of it, and so nothing we're seeing. And by the way, we see a lot of flows, and we don't see it anywhere. The industry is well capitalized, has good liquidity. Believe me, from last year to this year, people shored up their liquidity across the industry. Commercial real estate is a slow burn. It's a classic burn. In other words, if you go back in the late 80s and early 90s, we had a rolling commercial real estate recession, and so there'll be difficulties, and we're working at. But you know the trading attitude, which is these assets got to move at a price tomorrow morning, isn't the way the banking system works. And frankly, that's the value of the banking system. We work with clients. We figure out what you take a building, you figure out what the ultimate end state rental rolls will provide. You refinance it. Sometimes that wipes out the equity. Sometimes it doesn't. We're careful in how we underwrite as an industry. You know, the top 30 banks go through the stress test, which has an effect that says, wait a second, if you're underwriting out in an odd way, you have to put up the capital to prove you're right before you even get the chance to prove you're right. So in other words, your capital requirements will reflect your underwriting today, even though recession may never come. And it reflects your underwriting commitments under a scenario where commercial real estate drops by 30 or 40% instantaneously. So there's an effect on that on the industry, which is much more conservative building and much more middle-of-the-road building, which is probably slow down the capital provision to some of these companies, but on the other hand, it's not a bad thing when you get to this point. So we feel very good. Does that mean banks might fail? There's been thousands of banks have failed across the last 30, 40 years. That's what happens. Business models change. But on the other hand, the quality of the banking system is strong.
When we caught up in Switzerland, we were talking about the prospect of a change in capital reserve rules. Chairman Powell in his semi-annual testimony appeared to back away from that. What was your reaction to what Chairman Powell had to say in the last couple of weeks? Well,
we in the industry and we at Bank of America believe that we have, tremendous amounts of capital, liquidity. It's tested, the stress test. We don't need to keep moving the rules around. We're clear about that. And so, I think as people look at this, they're saying sort of what's the reason? In the end of the day, U.S. banking system and the U.S. economy are coexist with each other, and the U.S. economy has grown from pre-financial crisis now. The European economy has grown a lot less. The U.S. economy is much more vibrant. It's recovered from the pandemic shock faster. It's absorbed some of the things. And everybody says, well, that's because X, Y, or Z. But the reality is it's because the kind of capitalism practice in the country is good, and the kind of banking system, financial system more broadly, helps that happen. And so, we've weathered storms. Just think since early 2000, we've had a pandemic, recovery from the pandemic, the fastest rise in interest rates, 2 kinetic wars on the ground, a trade debates around the world, shipping restrictions. You go through all this. In the end of the day, this industry, we made $100 billion after tax from 2020 through now. And we built huge reserves, we took them back, we dealt with the pandemic, $70 billion of borrowing overnight, a flood of deposits, some of those deposits come out. That's the resilience of the system, and that's why we got to be careful about adding capital and stuff when the perceived risk we don't think justifies it.
In the meantime, there has been a shift in terms of consolidation of market share in some of the bigger players. And you were talking about how you were gaining market share. Who are you mostly gaining market share from? Is it the smaller banks? Is it from Europe? Where in particular?
Each of our businesses, our 8 lines of business, have different places they gain from. And so when it's the investment banking and with Matthew Coder and the trading team under Jimmy, that's largely coming from the long-tail people. This business is hard. It requires about $1 billion of technology investment a year to have a trading platform to keep up with it. So think about that.
Wow.
So when it's that hard, that means people who don't get the returns on capital have quit, and it's come this way. That's very different from the consumer bank, where Dean Athanasia and Holly O'Neill and Aaron Levine that run that business for us have just been driving core account growth. And so, they give you the statistics about constant accounts. We've grown our consumer base probably 4 million core checking accounts since the pandemic. So the deposits are up because of those extra balances. That's coming from everywhere. So it really comes from different places, but the idea is our job is to win the market and take it from every place.
When you talk about the investment in technology, how much is that going to be an ongoing benefit to a bank like yours that can invest in some of the artificial intelligence that we're hearing about every day?
So I think if you think about We got to be careful about artificial intelligence versus machine learning versus digitization versus digital practice, because it's all different things. But let me just give the simple stats. In 2010, we had 100,000 people in our consumer business. Today, we have 60. We had 6,000 branches at the high point about 2008. We have about 4,000 now. We had about 400 billion deposits. Now we have 900 billion. The amount of transactions going through is light years bigger, and we're doing it with 40,000 less people. And the expense base we run the whole company on today, nominal expenses of $64 billion, round numbers, is the same we ran it on 2015. That is all the stuff you're talking about. That's applying technology over and over and over again. And are we perfect? Absolutely not. Do we have room to keep applying? Yes. Is there plenty ahead of us? It's unbelievable. And so if you look ahead, we're basically running on neutral headcount, and everybody says, well, you're not hiring. We're hiring people in businesses and putting revenue generation capabilities out there. At the same time, we're taking it out of the expense base, and that's a constant strain. And it's pretty remarkable what you can do. But if there was some way you snap your fingers and change the whole thing, you would have done it. I mean, we're not.
What you just said, though, is so important, and can we finish there? I was going to jokingly ask you whether we'll all be replaced by a big supercomputer in the next 5 to 10 years, and I think a lot of the people behind us would like to know the answer to that question as well. But I guess effectively in the next 5 to 10 years, are we effectively saying that each additional dollar of revenue is going to be less and less labor-intensive because of this adoption of technology?
We had 300,000 people. We have 212,000 today. It's going to have less labor content. Are those people paid more? A lot more, because the way the labor content shifts. And so if you think about it, it will have less labor content because that is the expensive part, but it'll have more value added from labor because that's the way the mathematics will work. And so as you think about these trends, they're inexorable. They just keep going on. But people are forgetting these trends are already going on. And so one person's AI is another person's algorithm models that traders have been using for years. One person's AI is another person's Erica, which is 18 million customers using it every day type thing. And so you got to be careful about it. Is there potential here that we've never seen before? 110%. But the real question is, you don't have to wait for that potential. You're taking it out every day if you're working at it.